in this session, we're now going to have a look at specific adjustments that could affect the consolidated statement of comprehensive income that we saw in the previous video. So we're going to recap over some things that you've already seen before, but also have a look at some other specific adjustments that relate to the consolidated SOCI, or Statement of Comprehensive Income. Now, the first adjustment that we may need to make to the consolidated Statement of Comprehensive Income is if there is a mid-year acquisition of the subsidiary. Now, what we always want to try and reflect in the consolidated Statement of Comprehensive Income is the performance of the group for the year. Now, if the group was only formed halfway through the current year, well then the group would only be formed upon an acquisition of the subsidiary. Now, if we acquired the subsidiary on, let's say, the 1st of July 2011, and the date we consolidate is the 31st of December 2011, would it be fair to consolidate an entire year's worth of subsidiary profit when we only held them for half a year? Now, the answer to that, of course, would be no. Remember, we only want our share, we the parent, of what the profit the subsidiary has made in the post-acquisition period. Remember, the growth. Now, post-acquisition would only be 6 months of the current year, and as such, we would have to take the annual results of the subsidiary in their Statement of Comprehensive Income and pro rata for the length of time we held the subsidiary for. So let's say 6 months out of the entire 12 months of the year. So every line of income and expenses would be prorated 6/12. So we only want to reflect post-acquisition performance of the subsidiary because the Statement of Comprehensive Income is indeed a performance statement, but it's performance of the group, and the group will only be formed if the parent acquires a subsidiary, in which case we'd only want half the subsidiary's results in the year if we acquired the subsidiary halfway through the year, and therefore the group would only be formed for half of the current year. Now, if we held the subsidiary for many years and we're given the current year's results for the subsidiary, well, that doesn't present a problem. We consolidate all of parent, all of subsidiary on a line-by-line basis. No problem. But if it's mid-year, it is a problem relating to the Statement of Comprehensive Income. Interestingly, if you had a mid-year acquisition of a sub and you were asked to do the Statement of Financial Position, well, you don't pro-rata the Statement of Financial Position, assets and liabilities, well, because the Statement of Financial Position is as at. You don't say, as at the year end, I only had half the subsidiary's assets and liabilities. That's not right. Okay? So mid-year acquisitions only affect the Statement of Comprehensive Income, and that's why we're talking about it now, and we didn't talk about it in previous sessions when we were looking at the consolidated Statement of Financial Position. So, we must only include the part of the subsidiary's results that arose after acquisition, i.e., whilst under control of the parent. If the acquisition occurred in the middle of the year, we should only include the second half of the subsidiary's results for the year. So, let's have a look at a question then of how this would work. And let's have a look at an example in your notes. Pacify acquired 60% of the ordinary share capital of Scholar on the 1st of October 2011. So Pacify is the parent, with Scholar being the subsidiary. Revenue for two companies for the year ended the 30th of November 2011 was $2.2 million and $600,000 respectively. Assume profits accrue evenly over the year. So essentially, we make the same amount of profit every month over the year. Okay, there's no seasonal variations. There's no more profits earned in one month than another. Profits accrue and are earned evenly over the year. Required. Calculate group revenue for inclusion in the consolidated statement of comprehensive income for the year ended the 30th of November 2011. Well, I'd like to answer this question by doing an extract of a statement of comprehensive income to start to give you a feel of how we would prepare a consolidated SOCI. But we're only going to consolidate the revenue line at the top. So, pacify group consolidated statement of comprehensive income extract. And this would be for the year ended, remember that moving picture, 30th of November 2011. I say extract because we're only going to do one line of it, not the entire thing. So remember then from our previous video, we saw the pro forma statement of comprehensive income. Go and have a look at your notes and go and have a look at that pro forma. Do you remember we have 4 columns? But first a column for the narrative. We then have a column for the parent, pacify, parent for the subsidiary, scholar, a column for adjustments, which I'm going to abbreviate to ADJ, and then a group column. Now I'm going to work in thousands for this one, I think. And what we proceed to do is copy from the question. Now they told us revenue was what they wanted us to find the group's results for. Now, what we do is we consolidate 100% of the parent and 100% of the subsidiary. Now, the parent is the one preparing the group accounts. The parent has been in existence for the entire year. And therefore, you never need to time apportion the parent's results. Okay? So, the parent's revenue was 2.2 million. Well, we're going to pop that in. All of it, never time apportion. There's absolutely no need to. We only time apportion the subsidiary's results. Now, how long have we held the subsidiary for post-acquisition? Look at the question. Well, hopefully you should have guessed, or you shouldn't have guessed, you should have seen, that we acquired the sub on the 1st of October and we're consolidating at the end of November in the same year. All of October, all of November, we've held the subsidiary for 2 months out of the entire 12 months of the year. Now, we've been given revenue for the year for the subsidiary of 600,000. Well, we must time apportion 2/12 of that. So 2/12 of that is post-acquisition. That's what we want to include in our statement of comprehensive income. And what we'll get for that then is $100,000. No adjustments. So 2,300 or 2.3 million would be the group revenue that would be included in the statement of comprehensive income. So do you remember we did the group structure when we did the statement of financial position? We're going to have to do it here and note the acquisition date because it's very important in finding the correct figure for group revenue. So be very mindful of the acquisition date. If it's a mid-year acquisition, you must pro-rata the subsidiary's results for the length of time you held the subsidiary post-acquisition. Okay? And that's one of the typical adjustments that you would see for the statement of comprehensive income. Let's have a look at some other adjustments. Now, these other adjustments you should be fairly familiar with. Intercompany trading. Now, this is a key topic. Remember we said we only want to show external revenue and expenses, receivables and payables to those outside of the group. Okay? Any internal transfers of goods, well, we need to cancel that out because it's within the single entity. So, there's various different ways that this could be tested. Parent sells to sub and making an unrealised profit. Sub sells to parent, makes an unrealised profit. Parent sells to sub, or the sub sells to the parent, but then all of the goods have been sold to external customers, and therefore there's no unrealised profit or PUP to deal with. Because remember, PUP only arises when there's goods that have been sold between group companies that haven't yet been sold. Remember, that was one of our considerations when calculating the provision for unrealised profit. So, we already know how to calculate PUP and deal with PUP. We saw how we deal with PUP in the SOCI in the previous video. Parent sells to sub, add it to the parent's cost of sales. Sub sells to parent, add it to the subsidiary's cost of sales. The two key considerations are the same. Who made the profit? How much inventory is still in the group at the year end? And also, we learnt markups and margins once more and used that to calculate the PUP. That will still be the same. The only new thing is remembering to add it to cost of sales in the selling company's column. Now, the only other adjustment we'll see then is intercompany sales, which again we briefly talked about when we saw the pro forma statement of comprehensive income in the last video. We said if parent sells to sub, in the parent's revenue would be that revenue earned from selling to the sub. We need to strip it out. And as such, we need to debit and reduce group sales in the consolidated SOCI. And do you remember we do that in the adjustments column? Now, one company's sale is another company's cost of sale. The subsidiary's cost of sales would be too high with the amount of purchases that they recognised from buying from the parent. And as such, we need to reduce down their expense of cost of sales. So we credit and reduce group cost of sales, again, in the consolidated SOCI in the adjustments column. That's it really. It's the same principles and methodologies we saw in earlier sessions with the SFP. Now we've just got to apply them to the statement of comprehensive income. In our next video, we'll have a look at an example, recapping PUP, doing some intercompany trading, and possibly even doing some mid-year acquisitions.